it's quite a mixed picture right now that we're seeing in the Asian markets.
The support comes in the range of between 21,860 and 21,900.
I think AI is a pretty important theme, and the Magnificent Seven are all linked to that. So they are doing well.
Well, let's just take a quick look at what we have on the open. It's a slightly lower start, 40 points down on the Nifty.
So we got 50% in mid and small caps and about 50% in the large cap formats currently.
Even if you see our Q3 revenue, we achieved a revenue of 437 crores and a EBITDA of PAT of 87 crores.
While the litigation remains an area of uncertainty, the market seems to be unfazed.
Bit of a choppy morning since, a bit of up, bit of down.
So refinery, as we know, we are almost there, and our VRMP project at Vizag is almost over.
Direction now coming SBI's way that they have to share amongst all details the unique serial number that was assigned to individual electoral bonds.
For the markets, there's some recovery which is underway. We'll have to see whether that continues or not.
Oh, okay. No. Well, that's the day so far, and it has been a quiet day, I must say. Although as we get into the last 60 minutes, things seem to be picking up a little bit. This is Closing Bell. We're coming to you from the CNBC-TV18 Motilal Oswal studios. I'm Prashant. With me, my colleagues Reema and Mangalam. Guys, hi. Good afternoon.
Hi, good afternoon. In the morning, we were wondering whether this 21,900 mark will hold. It's an important support. And look at us now, 22,100 on the Nifty at the day's high.
Absolutely. Mangalam,
the only thing that I have to say is that the market's been meandering between this 20 and 50-day moving average sort of range. Friday, you look at the day's high, absolutely in line with the 20-day moving average.
Yeah.
Friday, you look at the day's low, absolutely in line with the 50-day moving average. What's today's low? 21,916. What's the 50-day moving average? 21,910.
Yeah.
So absolutely, there you have it. On the way up, now we're at 22,100. Does that mean we go all the way to test the 20-day moving average and perhaps give up on those levels? We're right in the middle of that range. And it's not just the Nifty. Even the Nifty Bank, has been in this range. Today's low has been held. And now we've conquered the 50-day moving average of 46,520. On the way up, 47,000 is the mark that we're looking at. So those are a lot of the index moves. I'm just looking at one stock, and something that caught me by surprise, not a stock that we speak about very often. That's Procter & Gamble, P&G. That's because almost 18 to 24 months of leadership of L.V. Vaidyanathan, and he's gone ahead, resigned from the company to pursue other interests. And now the company has a leadership change. Kumar Venkatasubramaniam, who was earlier the CEO of P&G Australia and New Zealand, will take over from May 1st, 2024. Now, Kumar Venkatasubramanian comes with a lot of, good growth behind in New Zealand and Australia, where they took the company to robust numbers. So maybe that's exactly what the street is eyeing out here as well. Growth above industry, improvement in market share, and innovative product launches. Because the one thing that I know of FMCG in the last few years, the biggest change in a company's growth trajectory happens as soon as there's a leadership change. So let's see whether P&G we can look at, from a leadership change strategy.
Okay, all right. Let's just actually go straight across then to our guest technical expert. Mitesh Thakkar is with us. Mitesh, hi. Good afternoon. Good to have you with us here. Just a quick word on the market and how we're trading. There's a bit of a bounce and we're up 80, 90 points. Will it hold, and would you want to trade it on the way up?
Yeah, so afternoon, Prashant. I think, we discuss about cutting shorts if we don't see a break between 9:30. This is the fifth attempt in the last 4 days on an hourly basis when the markets are kind of hit 21,950, 920 range, managed to hold and not break. So I think the shorts are out. We haven't taken aggressive longs, but I have recommended some intraday longs to our clients. Basically, the idea is that support level holding out multiple times, and what happens then is that the indicators start coming out of the oversold level, so there is a pullback and short covering happening. I think that kind of movement is going on. So I'm not sure whether I want to trade it because I'm not seeing a big reversal, but a bounce back to about 22,170 odd levels on this spot, and maybe 22,250 in a good case scenario. So I think around those levels, if we get a bounce back, and around 22,250, if we see signs of weakness or non-sustenance of the indices, then maybe take a short. But for the timing, if you had short positions, take your profits, sit and relax over it. On the stock side, I have a buy on PI Industries with the stop below 36.85 for targets of 3,800. And Pidilite I've recommended a couple of times because that's one of the stocks, which is showing very good structure on the daily, weekly, and the monthly charts. So Pidilite remains in a buying zone. Keep a stop below 2890. Look for targets of 3,000.
Okay, on the Nifty, it's now a good 100 points higher and a 200-point recovery from the intraday low today. The benchmark indices are up 0.5%. Metals are doing well. The Nifty Metal Index is a gain of 2.3%. You've got the Auto Index rallying. The Nifty Auto Index is up 1%, recovering from some of Friday's losses. And on the way down, IT is sulking. The Nifty IT Index is a cut of close to about 0.7%. Adani Group stocks, whether it's ports, Adani Enterprises, Total Gas or Green, these are stocks trading with losses of about 1 to 3%, and a couple of consumption names. Tata Consumer is the top Nifty loser, 2% gone on that. Titan is weak, Nestle, HUL, nursing losses and cuts of close to about 1%. And on the way up, of course, we'll talk more about steel and metals, but Tata Steel is the top Nifty gainer, and M&M and Tata Motors too rebounds after the losses that they had in Friday's trade. The good part is the advanced decline ratio is now back in favor of the gaining side. So pull up the advanced decline ratio. We've got about 1,300 stocks gaining for 1,000 stocks declining. Those two lines were crisscrossing through the day, but now you can see they're firmly in favor of the gaining side. Dipan Mehta is now with us on the show. Dipan, any thoughts on Coforge? You look at IT very closely. They've gone ahead and announced a large fundraise of 3,200 crore. The street suspects it could be for a decent size acquisition. But at least as of now, the near-term reaction seems to be more on the equity dilution bid and not the potential benefits, the white spaces that they will fill with this acquisition. How would you view this, development over a medium term?
Ladima, good afternoon and thank you for having me on your show. Yeah, it's a bit surprising. Normally, you don't see IT companies go ahead and raise capital. They are famous for doing buybacks, but here we have a company trying to raise capital, which I think has kind of spooked the market. And whenever they do an M&A activity, that risk factor certainly goes up because there are integration issues. And in times like this, you may tend to overpay, but let's understand what the management has to say. But by and large, as a disclosure, although we are invested in Coforge, at these elevated levels of valuation, I don't know whether it makes sense from a risk-return profile to take a fresh position in Coforge. There's no denying the fact that this company has, created stellar value, and amongst its peer group, it's a high performer with top quartile type of growth rates and very aggressive management. Last 2-3 years, they demonstrated that. But a lot of it isn't captured in the price, and even last 2-3 quarters, their growth rates also have been slowing down in line with the industry growth rate. So while you are invested, I think best to remain invested and ride out this uncertainty or volatility. But from a fresh investment perspective, I'd avoid it.
All right. Metals are the ones that are flying away as we speak. Most metal stocks at the high point of trade, and upfront is Tata Steel, as Rima pointed out. JSW Steel too has moved to the high point of trade. The entire index doing well. Could we attribute this to a brokerage note coming in from JP Morgan? Vamakshi joins in with the details of that note. Vamakshi.
Well, absolutely. All the metal counters are in focus today. Let me take you through the brokerage note that came in from JP Morgan, and they have highlighted that they do believe that NMDC's iron ore prices could see very sharp cuts in the near term, and a couple of factors for that include that NMDC finds prices are now at almost 40% premium to export parity, and this is as per their calculations. Moreover, their checks are also indicating that iron ore export prices on India's east coast have sharply declined, and this is in tandem with the stock build-up at ports. Not only that, their Australia Metals and Mining team has also highlighted that there are potential demand risks in China, and one indicator of that is that the China construction site restarts since the Lunar New Year are at only 63% as compared to nearly 73% as seen last year. So that is a bit of negative for NMDC, but who is in fact benefiting from these declining iron ore prices? Now keep in mind that iron ore is a raw material for steel, and therefore falling raw material costs could benefit counters like JSW Steel, Tata Steel as well as SAIL, but it is expected to benefit JSW Steel the most, and that is because Tata Steel and SAIL have captive iron ore mines. However, what JP Morgan has highlighted that they are not ruling out downward pressure on steel prices, and in fact any positive factors that could play out on the margins could play out in the second half of FY25. So given all of those factors, the advocate buying JSW Steel and Tata Steel on dips, they think the medium-term outlook remains quite strong for India's steel consumption, but JSW Steel, keep in mind, it is their top pick.
Thanks very much, Mamakshi, for that. I mean, that note also goes on to point that it's possible because iron ore prices come off, steel prices can also come off, right? That of course is the risk, but they remain otherwise quite positive. Deepan, of course, is with us. Deepan, good afternoon. Any thoughts on the view that you heard from on steel?
No, I think pretty well covered. And there usually this sweet spot keeps coming in the steel industry, where the iron ore prices decline, but the spot prices of steel remain at the same level, so that benefit is there. And sometimes spot prices go up, but iron ore prices are stable. So this kind of a conversion benefit does accrue from time to time, but it does get normalized over a longer period of time. But from an investor perspective, you need to see the valuations over here. Tata Steel, JSW, JSPL all have run very well over the last 2-3 years. We are at a kind of a peak when it comes to steel pricing as well. And at peak cycles, I'm not sure these are the valuations that one would like to pay for them, almost around 1.5 to 2.5 times price to book. Normally, if you want to if you go back into history, the best time to buy steel stocks is when they are just about equal to their book value or slightly lower. And these companies are trading at far higher multiples at this point of time. So from that point of view also, I think that although there could be a trading rally because of good quarterly numbers this quarter, next quarter, but from a longer term perspective, 2-3 year type of perspective, and from a contrarian view, I still want to avoid steel stocks.
Okay, that's the view on steel. We'll avoid. Let's talk about auto ancillary stocks like Uno Minda, Varroc Engineering, CIE Automotive. They're all in focus following an upgrade from Kotak Institutional Equities. Sonia joins in with details on this note. Sonia.
Well, thanks a lot for that. As you rightly pointed out today, many of the auto ancillary stocks are doing pretty well. This after Kotak has gone ahead and upgraded auto ancillary names like Uno Minda, CIE Automotive and Varroc Engineering. They've upgraded these stocks to an add from a sell. Now, they talk about how there are very steady demand trends in the two-wheeler segment. Apart from that, there is also premiumization in this segment. But the other big trigger really for these companies is the government's push for electrification of vehicles, which we have seen with the new EV policy, with the incentives provided to global OEMs to come and set up manufacturing facilities for EVs in India. This will, of course, mean more work, more business for many of these auto ancillary companies. Now, they expect Uno Minda to continue to outperform the industry growth, given the market leadership in various segments. They also speak about how Uno Minda has a very strong execution track record. And when it comes to CIE Automotive and Varroc Engineering, they are looking at attractive valuations, because of which there is perhaps more upside in many of these names. Back to you.
Right, Sonia, thanks a lot for that. So those are all the stocks which are buzzing around from the auto ancillary space. Deepan, any of them that you like? And to add to that, I'm not sure whether you track Anup Engineering or not. That's the other stock which is up around 15% odd. They've made an acquisition too. Your thoughts on any of these stocks that you track?
No, see, we don't track Anup Engineering, but the other three companies, Varroc, CEI and Uno Minda, I think really there's an investment case over there. But again, I think valuations are on the expensive side as far as Uno Minda is concerned, but it has a fabulous track record. And what is excellent about the company is its diversified product profile. And I would say diversified OEM supplies as well, which kind of, protects them and reduces the volatility in earnings. The likes of Varroc Engineering, large portion comes from Bajaj Auto. So if sales are doing well over there, the company tends to do better. But yes, valuations are attractive for Varroc. And CIE, I think I would just pause because a lot of revenues come from overseas. And still, I think there are macro headwinds over there. And CIE also has an exposure to a lot of the engine parts, is my understanding. So from that point of view also, although it may be attractive, its performance in the past few quarters have been very patchy. So I'd avoid that stock. But Varroc from a valuation perspective looks interesting, as does Uno Minda. But Uno Minda, I think, is more on the expensive side. So investors need to keep that in mind.
Deepan, any thoughts on names like Prestige and Sobha, the primarily Bangalore-based players, real estate companies? Stocks are down about 20% in the last 7-8 trading sessions or so. I'm not sure how much of it is. I think there was, of course, all that social media noise about water problems in Bangalore. I read a CLSA report on it as well. Obviously difficult to quantify something like this. But it's a bit of a risk, right? It's a bit of a overall negative perception about and perhaps potential debt. People look twice again, especially those. Those who've got no choice, but for those who have a choice and are sort of deciding between cities, these are important considerations. Any thoughts?
Yeah, it's an interesting question. Actually, I was in Bangalore last week, and all the taxi drivers and auto drivers I spoke to, they said that this particular water shortage is just some kind of political maneuvering maybe taking place over there, and it's just an aberration. There's no real long-term water shortage problem in Bangalore. And eventually, I think the way the city is growing and the kind of demand which is there for the real estate over there, I'm pretty certain the likes of Prestige and Shobha will able to do very well in the longer term. As you said, 20% correction is good. Who's who knows the 15-20% type of a correction, and these stocks can really get to the value zone. Prestige, especially, I think is done exceptionally well and has got good exposure in terms of even rental assets, which it has in the past monetized, but then it's used those proceeds to set up fresh rental assets. And from that point of view, I think their coverage is more comprehensive, and they're doing some interesting projects in Mumbai as well, which are going to yield exceptionally good profits. So looking out for Prestige, looking for a sweet spot to get into that stock. But I'm not too concerned that just because there's a water shortage problem, Bangalore will lose its attraction as a premier destination for startups or even the technology sector.
I hope it does not. I hope they solve the problem. I mean, there is a problem. There is no doubt about it. But if there is anything which can, to think about it, if there is anything which can really, it's fundamental things like this, right, which essentially come in the way. Otherwise, there's going to be growth and there's going to be, there's top-tier talent and there's IT and there's startup. Of course, it's got a lot going for it. It's basically some of these other issues which become important when you talk about real estate. Mangalam,
they say when you enter Bangalore, it's the weather that hits you first and thereafter it's the traffic. So I don't know how that pans out. Deepan, I just wanted your thoughts on any of these oil marketing companies because, the price cut was announced on Friday. We did see an impact on that, on all the stocks as well. But now the street believes that maybe with crude at the levels at which it is right now, with the model code of conduct coming into place, all the price cuts are out of the way, at least for the near term. Do you think that it would make sense to perhaps look at any of these oil marketing companies once again?
So I think you've seen a good trading rally in oil marketing companies, and to an extent, I feel intuitively that one should get light as in these companies. We are in the midst of a correction. No doubt today is a good day, but the structure of the market and the way kind of reports are coming, you could have a deeper correction or at least sideways movement. I don't expect a runaway parabolic type of a move in stocks at this point of time. And we are seeing good quality stocks correct as of now around 15 to 20% or so. And if Nifty and Sensex correct by another 4 or 5%, then these stocks, the good quality stocks, would go down another 10, 15, 20% or so. I think after 30 to 40% type of a correction, which we are expecting over the next few weeks or months, a lot of good quality stocks will become very interesting, quality businesses at reasonable valuations. So we'd rather keep the powder dry for those sort of stocks in that scenario than go and look for something like oil marketing companies, which are at best good trading bets. And this kind of, tinkering with the pricing all the time doesn't really augur well from a sentimental, long-term sentiment point of view. And in this interim period of oil prices were to go up, then these companies will report negative earnings growth. So from that point of view, we've not been great fans of oil marketing companies. In bull markets, when you want to go for cheap stocks, they are great. But in markets like this, where we are seeing a downward trend line, downward pressure, we'd rather just wait and watch and look for good, solid businesses which have got very high moats, and then they may be available at reasonable valuations.
Any thoughts on Sapphire or Devyani International? Generally, QSRs have taken a beating on account of competition, high inflation. Stocks have underperformed. But UBS today has come out with a positive note, and they've put a target price of, I think, 190 rupees on Devyani International. And even on Sapphire Foods, they are expecting significant upside. Do you think all the negatives are priced in and it's time to look favorably at QSRs?
No, not so, Riva. I was very disappointed with the numbers which came from the QSR. If this is a high growth segment, then this is not the kind of number that these companies should report. Same store sales growth has been negative, and even the kind of network expansion has been a bit disappointing. There's a lot of competition coming in for these companies from unorganized sectors which are channelizing their sales through Swiggy and Zomato. And I even read an article that this entire ONDC is also shaping up pretty well as far as food aggregators are concerned. So I just want to just reserve my opinion. Just wait and watch how these companies actually perform going ahead. And no doubt they are great consumption plays, but when you look at other consumption themes like maybe say travel, hospitality, healthcare, those are far more appealing than the likes of QSR. So, and valuations really are staggering when it comes to Devyani and Sapphire Food, or even Westlife, or even Jubilant Foodworks for that matter. So, I would avoid all of these companies. Although, as a measure of disclosure, we do have a long-term position in Devyani International.
The other day, I was speaking to someone, given the sort of growth rates that we've seen in both the QSR and the FMCG space over the last 4 or 5 quarters, they've said, how about renaming FMCG to SMCG, slow moving consumer goods, and QSR to not so quick service restaurants?
Well, that's an interesting way to put that, sort of categorize that space. Deepan, we leave it there. Thank you very much for your time. Great to speak with you here on CNBC TV18. Appreciate it. Well, that's Deepan Mehta with thoughts on a variety of sectors. The stocks markets up about 90 points. 22,100 is where we are at. We'll take a quick commercial break here. We'll come back. We have Rupen Rajguru from Julius Baer joining us on the other side. That conversation coming up. Okay, welcome back. The market, I think, is not building on gains. It's given up some, I think, about 20, 25 points from the highs of the day. But still, this is a pretty good outcome overall. 70 points nearly, 22,100 is around where the Nifty is trading at. And of course, broader markets have also paid losses. And their mid-cap and small-cap indices, I think, are still down, but just a little bit. And market breadth has become even more positive. 1,400 stocks are higher, 1,100 stocks are lower among the actively traded NSE stocks. Rupen Rajguru is with us. He's Head of Equity Investment and Strategy at Julius Baer. Rupen, good afternoon. Good to have you with us here. Thanks for your time. And I think we're speaking after that correction that we've had in mid and small caps mostly. And the sharpest since this rally began in March of 2023. But let's just talk about, I know that you prefer mega caps, large caps. That's top of the list, right? But you're not averse to small caps and mid caps as well. But what exactly, in terms of themes, etc., are you bullish on? Are you looking to buy? So, for example, cement is something that you like post this correction. There are other sectors as well we'll talk about. But within the ones which have fallen, I mean, does anything anything you've been able to identify, pick? If you can talk about specific names.
Sure. Hi, Prashant. And in fact, probably beginning of this year, everybody was expecting a correction in small and mid cap. And, as I would call this is rather the most anticipated correction in the small and mid caps. Here, particularly about the sector which you mentioned, like cement as a sector is something which we have been liking from a medium to long-term perspective. In last 1 month, it has seen a decent correction. A lot of the names are down 7 to 10%. And in a long cycle, always there are short cycles and in which market reacts to. So in the current scenario, the pricing has been soft. And because of that, the Q4 might be a soft quarter. Probably a month back or month and a half back, everybody was expecting a strong Q4, but the Q4 might be weak, and hence the stock has corrected. But if you look into the picture, what themes or what sectors we like is that we like those sectors which will have a decent top line growth. And by cement, I mean the volume growth of cement for last 2 years has been higher than the nominal GDP. Probably the next year also the volume growth will be higher than the nominal GDP. So if the pricing discipline remains, which is what we expect, notwithstanding the current softness, we expect the top line should be good. And also at the input cost side, it should be quite benign. So hence we expect a decent FY25 from cement companies. So we like cement as a theme. The other sector which probably has not done as well in the current market scenario are the large private sector banks. And probably it is now more or less a consensus trade amongst the fund manager. And we are also on that camp, and we believe mega private sector banks is something which has a relative value in the current market scenario. So these are the two big themes which we like in the current market scenario. And then there will be always bottom-up ideas across the sectors is what which we like.
Right. That's interesting. You do like the private sector banks. Just wanted your thoughts on a couple of IT names, because you did see that IT could perhaps be one of the dark horses. So have you updated your thoughts there? What do you have to do there?
Yeah, hi. Afternoon, Mangalam. So in IT, probably, there is this, if I were to call the Q3 results, so IT was one sector which came out with pretty weak set of numbers, but the stock did exceedingly well, particularly a lot of the large cap names. And banking are the one in which the numbers were pretty strong, but the stock did badly because the expectation is that the next year there will be NIM pressures and there will be challenges on the growth side. So IT, I believe that the large cap ITs are probably fully valued. So I don't see a huge upside in those large cap IT names, because now in the pricing, everybody is expecting a recovery in FY25 vis-a-vis FY24, because from a numbers perspective, FY24 was kind of a washout number. And I think for 5 or 6 consecutive quarters, we have seen the IT hiring also going down. Probably there are interesting ideas in the smaller IT names while they are on valuations, but the growth of some of the small cap or rather mid cap IT names which are specializing in the have a strong growth. And in a scenario in which, when the overall large cap IT is not posting decent growth, some of these names will be preferred. At an aggregate level, we don't like this sector, but between the two, probably we feel there is some bit of juice in the mid cap names, specifically on the ER&D side.
Got it. Rupen, afternoon. You don't like the residential real estate players. Is this a recent development where you've turned cautious? The developers?
Sure. Hi. Afternoon, Rima. So, real estate as a sector from the lows, probably COVID lows, on an average, the stocks are up 5 to 10 times, depending on what kind of stocks you're looking at. And as a cycle, probably we are in that mid-cycle of the entire real estate story. So what's happening now is that incrementally, if you hear the commentaries of a lot of the players, the ratio of so-called investors stroke speculator vis-a-vis the genuine end users, that ratio is slowly going up. So probably it was 2-3%, and it's now up to 10 to 15%. And in some of the markets like Hyderabad and Pune, that ratio has gone up significantly. So there is clearly people are betting on the price hikes out there, and that's where we see some of these elements out there. So as a theme, we like the theme, but we believe the better way to play the entire real estate boom would be home improvements companies, because they typically move up after a 1 to 2 year lag. In fact, the largest adhesive company also spoke about 2 years after the real estate cycle, they are seeing a big boom in their market. So at a margin, we would prefer home improvement companies, consumer durable companies to a real estate companies, because that's where we believe from a pure stock market perspective, there is a better valuation vis-a-vis the real estate company at current juncture.
There's another space, right? The QSR space, Rupen, that you like. What's the top idea there?
So, Prashant, I'll refrain from talking about stocks, but if I were to look through, QSRs were darlings 3 years back, and today probably it is considered, I think, just before our conversation, Mangalam was referring to, I think, slow or moving services or something like that. So here we have always seen in a 5 to 7 year cycle, there are periods of 1 to 2 years in which there is slowdown. Very difficult to fathom the reason behind the slowdown. It can be higher competitive environment, it can be higher inflation, but at a big picture level, the story remains intact. And in fact, some of the large QSR companies, in last 1-2 years, they have continued their focus on network expansion. So they are increasing their footprints into various geographies. At the same time, they are also, some of the companies are improving their entire back-end system, and they are improving on their efficiencies. A lot of commissaries and all are getting developed. So they are preparing for the next leg of growth. So we have seen it historically with a lot of these QSR companies. While some of the companies don't have that long enough track record, but the company which has the longest track record as far as the stock market is concerned, we have seen this cycle play out in the past, and we believe that the kind of investments they are doing, when the cycle kind of turns, we will see a huge growth in their overall earnings. So at a sector level, we are constructive on that sector, and probably the largest name is something which looks pretty interesting at current market price.
The counter to that perhaps would be that why is one looking at just one company and a few brands in one QSR when one can go to one of these platforms and get access to the entire basket of restaurants which are there? And that's reflected in the kind of price performance that we've seen in Zomato versus the other QSR players as well. And that's reflected in the quarterly growth run rate as well. What would your thoughts on that be?
Yes, in fact, Mangalam, if I were to turn it around and say probably a year back, the story was very much there. But a year back, the largest listed food tech company was probably 1/3 of the current market cap. And, the people were always having a narrative in which, they were questioning the overall growth prospect out there. So yes, you're right that the competitive intensity has gone up, and thanks to food tech companies, the access to a variety has increased as far as the customer is concerned. But what we have seen historically, some of the large brand, when they expand their footprints, they get into tier 2, tier 3, tier 4 cities. And again, if I were to compare some of these companies vis-a-vis the footprints they have in China, probably in India, we are at, probably 1/10 of the number of stores which, they have in China. So have we exhausted that? The answer is no. So I would call it, always competitive intensity will be there. And then if I were to draw an analogy, probably 20 years back, with some of the FMCG companies also, when an incumbent competitor comes through, they were questioning the growth of that. But we have seen that those companies, come up and recover pretty fast. So to answer your question, do we see exhaustion in the entire category? The answer is no. There is definitely a slowdown, and probably in hindsight, historically, we have seen in a business, if our hypothesis that this industry will be much larger in next 10 years from what it is right now, corrections like these are historically always been a good opportunity to add into those.
Rupen, thank you very much for joining in. We need to slip into a very short break. On the other side, we'll get you a check on what dealing rooms are saying in our segment D Street Chatter. We also get you a few BTST calls from our experts.
Welcome back. The market's been volatile, in a range but volatile nevertheless, because just moments ago we were talking about the Nifty being higher by almost 100 points. That gain has been given up. The Nifty is now higher by just about 15 points, up from the day's low but off the day's high as well, and that's the kind of market that we've been in right now. It's the Nifty Bank which is taken a turn for the worse around the 50-day moving average. That's where it's hovering around, and a bunch of these stocks are not doing particularly well, seeing a wee bit of sell-off from the higher levels itself. Good time to get in dealer's perspective of what's actually happening in the market right now. Nimesh joins in with the D Street Chatter segment. Nimesh.
Hi, Mangalam. A bit of recovery in the market after a big sell-off last week, but again, the flows are quite mixed is what I understand. Again, the broader markets continue to underperform, though even in the broader market, some stocks have managed to recover after the big losses or the big cuts last week. In terms of sectors, the mid-cap IT is underperforming thanks to Coforge, because that's been the biggest loser on the back of an equity fundraising, and that's a bit negative for the stock, so that's down. On the other side, some bit of buying interest seems to be back in the metal names, especially the steel stocks. A, there is buying interest, and B, there were reports as well which suggest that the iron ore prices have fallen sharply, which adds to the margin of the steel businesses. So that's the reason why the steel stocks have done well today. Technically, 21,800 seems to be a very strong support on the downside, but broadly the sense I'm getting is maybe you'll have another few days of larger consolidation before the up move starts. So maybe still some bit of the March phenomenon seems to be playing out in the broader market stocks.
All right, Nimesh, in terms of specific stocks, what are you picking up?
Well, in terms of individual names, Prashant, the first stock on my list is BHEL. That's been getting in trade today, good volumes as well. And now, and I understand the street is anticipating a large order win for the company from a private company very soon. So that's something to track in BHEL. The second name is Copran. Small stock, 1,300 crore market cap company, but that's been gaining traction of late. Volumes are also on the higher side. I understand some HNI investors are quite active as well in the stock. Interestingly, on Friday there was a block of 0.5% where Capital International bought. So that's keeping the stock exciting in today's trade as well. So that's Copran. The third name is Indiabull Real Estate. That's been buzzing in the last few days. In fact, in 3 days, the stock is up almost 15%, good volumes as well. And I understand the company is likely to raise funds largely through a pref issue very soon. So that's something to track in Indiabull Real Estate. And the last name is Indus Tower. That's been consolidating in a narrow range of late, but the city is anticipating a large block deal very soon. So that's something may come maybe closer to this weekend. So that's something, in Indus Tower, large block to expect very soon.
Okay, all right. Nimesh, thanks very much for that, and we'll come back to you for more later. But interesting list, Indiabull's Real Estate, as Nimesh pointed out, one of the, it fell into 2 digits, but is I think back at about 120 plus. So fundraise via, largely a pref issue. That's the route that Nimesh is picking up. So we'll keep an eye out on that one. Big volumes as well. Actually, on Friday it went up 10% on very, very large volumes. So that's something to watch out. Well, let's talk about trading ideas, BDST trades essentially. Mitesh is back with us with exactly that. Mitesh, so not holding, neither here nor there. 30 points now.
Actually, I spoke about this, Prashant, saying that I don't want to buy into this bounce back. We've cut our shorts. I think it's the fact that multiple times we have kind of taken support at 21,950 and failed or failed to sustain or go below that. Therefore, I think some short covering is happening, but this is not a reversal. I think avoid the index for the time being. Either short on a hourly close below 21,930 or close at about 22,250 levels, 230 zones. I think that's the level to short. Till then, I think just sit tight. But on the stock side, I have a couple of reversals named, which are on the buy side. So I have BTST call today. Apollo Hospitals is a BTST with a stop at 6,100 for 6,180, 85 as the target area. And Tata Steel, I think metals are showing some signs of reversal. So Tata Steel is a BTST. Keep a stop at 148.5 for targets of around 153.
Okay, that's some trading ideas. By the way, IT continues to tumble. Infosys, TCS are down close to about 2%. Infy is a cut of 2%, while TCS is down 1.7%. And the biggest knock today has come in on Coforge, where the board has gone ahead and taken an approval to raise funds to the tune of 3,200 crores via a QIP. The street is concerned about the potential dilution. But there you have the fall that we're seeing in IT stocks in the last few minutes. The Nifty IT index also, if you can just get that up for you on your screen. When we started the show at 2:30, The index was down close to about 1%, but in the last 30 minutes, the slide has extended itself and it's a 1.6% knock on the Nifty IT index.
You know, if you remember, we had the LTI Mindtree management with us on Friday.
Yes.
I think it was Friday. It was Friday, I think. And a fairly large company in the mid-cap space. And we asked them about the business environment, etc. It was not really inspiring any confidence. They said,
Still cautious.
Still very cautious.
Still very cautious.
At least a couple of quarters out, that kind of commentary as far as the overall environment is concerned as well. But Anand Tandon is with us with what he's making of things. Anand, good afternoon. Good to have you with us here. So let's just start with IT services and, waiting for some recovery. The thing, though, is if this underperformance is based off, what's happening in the US. The US is doing just fine. It's actually maybe it's strong, if not exceptionally strong, by all accounts. And here, everyone is waiting for the shoe to drop for the last year and a half now, since when this underperformance has started. So I'm not sure if that is exactly the big dominating driver. Just your thoughts, Anand.
So yes, the US is doing very well, but the only challenge is that the US, the top 7 companies which are doing well are a different kind of IT company, right? They are not really in the services business. They are all companies which have something unique about them, and therefore they are market leaders in their own right. The rest of the companies on which our IT services depend.
Yeah, no, I meant the US economy. Sorry, to be clear, I meant the US economy. You're going to nitpick some data is soft, etc., but generally it's in pretty good shape.
Certainly, it is in decent shape, but the part that our companies are basically going to run off, which is essentially the retail, the banking and finance and so on, are not necessarily the ones that are doing the best over there. You have various sectors there doing well, but increasingly even there is talk that the market is running ahead of the economy, and the economy may not be as robust as the market is making it out to be. But that's a different story. The reality is that because of the various developments that we are seeing, I think you are beginning to see AI bite. You are beginning to see a lot of people deciding that more of the mundane activity can actually be done by a fewer number of people, and therefore they are not in a hurry to source a lot of people. And you've had another round of bloodletting, as it were, in the US IT companies as well earlier this year. So it is not that all is hunky-dory as far as the manpower-based IT business is concerned. It's the product companies which are doing well. And from that perspective, even when you looked at this year from all the directions that the IT companies gave, it was essentially soft. It was a little better than last year, but nobody is going out and saying that, look, we are going to get serious double-digit growth. So in a market where the companies are already trading at, on an average, 2 times growth ratio, your PE to G ratio is almost 2 times plus. With a growth which is very anemic, it is not particularly reasonable to expect that the IT companies will be great performers. That said, I think if you do have a market which is slowing down overall, I would argue that it is still a place where you could perhaps come in and hide, because there is also not that much significant downside expected, because most people are underweight that.
Is it time to reduce equity allocation? A lot of people have made a fair amount of money. Now the belief is that maybe interest rates are topping out as well. So before the first rate cut comes in, is it time to move towards debt?
Certainly, the markets have kind of extended themselves. If you look at the small cap, for example, it is trading at more than 1 standard deviation over its mean. The large cap itself is not looking particularly cheap. It is not as expensive as the small cap, but it is also expensive relative to its own history. And as you said, you may actually get a little better return even if the interest rate were not to fall. The earnings yield, the debt yield is fairly attractive at this stage. So if you were to assume that part of what we are expecting in terms of corporate earnings growth for the next year has paid off already in terms of higher equity price, is very much in the order of 10-11% for the Nifty stocks in the year ahead. That's where the consensus is at this stage. There is not particularly any reason to assume that you will outperform the debt market over the next, let's say, 12 to 18 months. So till you don't get some meaningful correction, it may be actually quite a good idea to move out somewhat from equity. But that, of course, depends on your starting allocation. Most people in India, even today, are significantly underweight equities, and from that perspective, are not necessarily, in a position where they can reduce their allocation meaningfully.
Got that point. Anand, do stay on. We need to slip into a very short break. But as we do that, let's get in an important voice from the oil marketing companies. Remember last week, the government announced a 2 rupee price cut in fuel prices. Now, most brokerages, including Morgan Stanley and Citi, said that HPCL could be the stock impacted the most due to the price cut. Earlier today, we had a chat with the company's marketing director, Amit Garg, on the fuel price cut. Listen in to what he had to say.
So the time was right, and we thought that, this is not going to make a lot of impact on our margins at this point in time. So we took a call and we reduced the prices. And I think, talking of the market, they had kind of taken it in their stride because they knew that something was coming. So market was ready for this. We take our own calls, and our companies, we do not operate on a daily basis. The companies are going through a phase of transition. And we need to invest a lot of money into the future energy, the new energy, the green energy, as we call it. So we have to take very calibrated calls. We are growing much higher than our peers during this period, and we hope to continue to do the same. And even as we talk now, so we have grown by more than 1% more than our peers, the nearest competitor. On a marketing basis, if I say as a company basis, next 5 years, we are kind of split between the core and the new energy. We're just having some discussions, and almost 50%, 48% or so, the new expenditure is going to be on the new energy.
Welcome back. IT index is now down 2%, so the sell-off continues. TCS is the top Nifty loser, 2.2% gone on that. Infosys is the second the second biggest loser on the index. That's also down more than about 2%. And some of the gains are coming off Hindalco. Hindalco is now dipped into the red. Hindalco is down close to about 0.4%. And from the day's high, it slipped nearly 1%. So IT and a couple of these consumer names led by Tata Consumer, HUL, Titan are under pressure. So these are the two pockets where there is weakness. Dilip Bilkon has got some order and that stock is up 1.5%. The order win is it's a letter of award acceptance to the tune of about 412 crore. Still in conversation with Anand Tandon. Anand, any thoughts on, Coforge and the fundraise? Why is the street so disappointed by this fundraise of 3,200 crore, in your opinion?
I'm sorry, I don't track that closely enough to be able to comment on that.
Okay. Any other stocks that have, looked interesting to you in the last 1 month, particularly the correction that set in the last fortnight?
Well, like I've been arguing before, one should be looking for slight outside equity exposure. So if you have to look at those, it would really be commodity-based stocks. So, I would be bullish on things like ONGC, gas, metals, especially copper-related and so on, which I think are the ones that I would play for, given the fact that my anticipation is that you will find that the currency becomes a major play once the US the currency starts to weaken in anticipation of an interest rate cut.
Right. Your thoughts on real estate once again, because it has been a trade which everyone's looking at. I don't know whether it's crowded or not, but stocks keep moving. Macrotech developers, for instance, up 13% right now as we speak. You have a lot of these names which are constantly doing very well. How long before, or how far further are we in this upcycle of real estate stocks?
Well, I think we are in the top quartile in terms of where these stocks can go in terms of near-term returns. You have to keep in mind that till about 2 years ago, many of these stocks were actually in the doldrums, and consumption in terms of real estate, especially housing, was not very strong. And that has certainly changed over the last 18-24 months. We are now seeing a very, very robust demand. And obviously that is translating into bottom line growth for many of these companies. But you have to keep in mind that these are cyclical industries, and looking at a long-term picture and saying there is a housing shortage which runs into millions is of no use, because at the end of the day there is a question of pricing, affordability, and so on. I think at the upper end of the curve there is no doubt that there is a huge demand that comes through. At the lower end, again, there is an issue. There is a reasonably robust demand. It's the middle range which is a problem, as in most of the other cases. But the middle range is the one that is also the one that is likely to be buying the most, because given the affordability. So if you make it unaffordable there, there is a challenge. At the lower end, the builders don't make money, and at the higher end, the market is severely limited.
Anand, we'll leave the conversation there for now. Thank you very much for joining in after... we're closing this, the start of this week with a minor gain of close to about 31 points on the Nifty, the sensex higher by close to about 100 points. We're significantly off the session lows. The intraday low today was 21,916. So from the day's low, we've recovered close to about 130 points, but we've also slipped 70 points from the day's high, which was a level above 22,100. Sectorally, IT took a hit, index down close to about 2% on the way up. Metals was the top Nifty gainer, 2.3% up. Autos did well. Mid-caps, neither here, neither there. A little bit of a knock coming in on the mid-cap index. The advanced decline ratio absolutely even. One stock advancing for one stock declining.
Absolutely. I mean, it was a day where the mid-caps didn't make big headlines by virtue of falling too much or gaining too much, even Stevens. So let's see where they go from here on. But metals were definitely the toast of the day. We had big gains coming by, especially on the steel names, even at the mid-cap end of things. It wasn't just Tata Steel and JSW Steel. But from the broader markets, we had SAIL, which was up 3%, JSPL up around 5%. And then we did see some, PSUs come back in fashion as well. PSU banks, Union Bank did well, BHEL did well. On the way down, though, it was all about mid-cap IT, Coforge, the top F&O loser, Birlasoft down around 4%, Persistent Systems down around 3% as well. And then on the fringes, we had some stocks like Anup Engineering up 15%, Macrotech in the last hour of trade or last dying minutes of trade shot up in double digits, Hindware Homes up 10%, and we had Kohinoor Foods, which were locked in upper circuit as well. So a few fringe stocks seeing big gains, but by and large an even Steven sort of market.
Oh, absolutely. And, just a few other names, right, before we wrap this up. The Adani Group stocks were, of course, under pressure. The Adani Total, for example, Adani Energy Solutions, there was some pressure across the board in that group. Hudco was lower, large volumes as well on it. NCC is another one, which was down and out. Prestige and Soba both. Lodha was, of course, rallying, but that's largely Mumbai-based, but some of the Bangalore-based players were down. Phoenix Limited, the mall operator, that was down. There was IRB, which was lower. Nippon Mutual Fund, that was also slightly lower. So this is, the list of some of the other losers that we had. But all in all, I mean, not really very much to sort of take away from today's session in terms of sort of a signal for what comes next over the next few trading sessions. The global is also, of course, going to be important. Tomorrow morning, we get the Bank of Japan meeting decision. And after many, many, many years, maybe the Bank of Japan perhaps will increase interest rates. So that's going to be interesting to watch from a global impact standpoint. It's a wrap on this edition of Closing Bell from all of us here. It's goodbye. Thank you for staying with us. But don't go anywhere. We are coming back right after a very quick commercial break and pick up all the action on Markets Forward.